Hello, 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 and welcome to the Options Hour. This is TFNN, and my name is Victor Jones. Over the next hour, we're going to be talking options, everything options. You know, obviously, we've got a couple weeks here into expiration, so we're getting close. Some of you may be putting on some weekly. Some of you may be getting ready to roll your positions. But whatever you're doing, obviously, going into the end of the year, it's going to be a huge expiration, right? I mean, it's December expiration, not the largest one, right? But it's definitely going to be a very interesting expiration. And if you look historically, you know, we've had an uptrend into December expiration. If you just kind of look at what the historical trend is, and so far, you know, we haven't bucked that trend, so to speak. So we've had kind of an interesting rally in the early part of this expiration. And we're approaching the upper end of the range. The S&P 500, 1255 and 3/4, really pretty much unchanged. I mean, we're up about half a point, but relatively speaking, versus the volatility we've seen over the last couple of days, last couple of weeks, I should say, that's relatively unchanged. The Dow, 12,124 points, up about 58 points on the day. Again, you know, obviously that's not unchanged move, but that's, you know, again, relatively speaking to the volatility we've seen, pretty much no action there. VIX, interestingly enough, is completely unchanged, 2784 on the day. For market wrap up, that's about as good as it goes. We're going to do a little something different here. Again, I think over the last couple of weeks, we've done a lot of on-air content, maybe an hour of straight talk with a couple of questions. We'd like to take as many questions, I think, for this particular session as possible, guys. So give us a call at 877-927-6648. That is 877-927-6648. I don't care if it's stocks, options, option strategy, complex options, futures options, anything you guys got, give us a call and let's talk about it. I think a little bit later on we're going to be talking about some strategies, some interesting strategies into the end of the year, but I think for the most part, or at least first, we'd like to take as many calls as possible. Again, 877-927-6648. We got the question right there in the Tiger Den, and I appreciate it. First question, are you bullish now? Well, I got to be honest, guys, and we talked a little bit on it on the 5-minute wrap-up yesterday with Tom. I mean, look, when we were trading, if you look at essentially what we've done over the last 3 or 4 months, and again, I'm not necessarily a technician, but you have to know where you've been in order to make logical assumptions about what the future holds. I think in terms of this market, and you have to understand market psychology, and in doing so, and looking at a chart and understanding the tape, I think you get a better feel for what potential underlying market psychology is basically shaping up. And I think over the last 4 months, what have we said? We've continually said range. I don't, if you want to call it 1,200 to 1,275, if we're just trying to ballpark that range, essentially that's how we've been trading. And I think you saw a little bit of overextension to the downside once we broke, I think, we broke the 1,200 level, and then what you saw is a reversion really to that level of basically 1,100 to 1,200. Probably 1,120. I want to say to 1,200 is probably the expected range, and you saw us basically overextend here recently down past the 1,200 level, but we quickly recovered. And I think if you listened into a couple of weeks ago, we essentially said that what we're shaping up for, in terms of this 1,275 to 1,200 range into the end of the year or through Thanksgiving is a potentially, a little bit of a correction to the 1,200 level. I don't think, there were some people that said we could go to 1,175 on an overextension. And, we essentially did that. We overextended just a bit before recovering to the 1,200 level, and interestingly enough, immediately in a substantial move in the S&P just a couple of days ago, rose to the top end of the range. So for me personally, I think into a December expiration, you tend to have an upward bias. When you talk about bullish, I think you have to be very careful. I think it's short-term in nature. Do I think we have some upward potential from here, potentially into the 1280 range into December expiration? Yes. Am I bullish in terms of putting on January positions? Not necessarily. I think in looking at January, the market's going to kind of have to convince me that 1280 range is something that the market really wants to pull higher than. But interestingly enough, and it's a great question, G7. I mean, interestingly enough, the market, the market essentially pushing up at 1280. The consumers have shown up. I mean, the consumers, if we just look at what the numbers told us, I mean, obviously going into Black Friday, we had tremendous numbers. Going into Cyber Monday, $1.25 billion spent by the consumer versus $1 billion in 2010. So a substantial increase there in consumer behavior. Over the week, basically, of holiday spending, consumers spent over $6 billion. So, I mean, G7 says iPads. And, so it's very, very interesting. I mean, the consumer is showing up. CPI numbers were relatively good into the holiday, so I think the return to the top end of the range is definitely warranted. Whether or not we break through the 1280 level is to be proven, in my opinion. And if we do, I think the 1340 is obviously the next range that we'll be gunning for. But with that, though, let's look at a few underlying securities. And again, guys, feel free to give us a call, 877-927-6648. If you have any questions, we'll jump into them. Give me just a second. Going to go ahead and get everything set up here. So if you have any questions, feel free to give us a call, guys. And giving the guys here my number so they can text me and let me know who's on the line. So for everyone out there, again, I think we've got G7 in the Tiger Den who wants to look at a put spread in X. We want to look at U.S. Steel here at $27.78, down 73 cents on the day. That's about 2.5%, a little over 2.5%. And if you've been watching the show, we've made some interesting plays here over the last couple of weeks. One recently, Frontline, and we'll get into that trade and how that's looking, if that's something that either you've been tracking or you actually put on as we discussed it. But in U.S. Steel here, you've essentially, just like the rest of the market, we've been range-bound here. A little bit of a tighter range in here, about 22.5 to about the 27.5 range, about a $5 range essentially over the last, maybe 2 months. And right now we're at the top end of that range, as is the market. And G7 says, how would you look at putting on a bull put spread here? Many are bullish now here at this level, and that's, again, from the words of G7. So we'll look at potentially putting on a bull put spread here. What if you're bullish, but we're at the top end of a range? How would you take advantage potentially of something like this where you're bullish, but you're at the top end of the range, and give yourself a good percentage chance of being right, even if you're wrong? And I'll tell you exactly what I mean by that. I'm going to go ahead and navigate here to X, the trade page of the ThinkorSwim software, currently trading 27.81. Clearly, with only 10 days to expiration, I think there's not enough, risk to reward in terms of putting on a December position. So when we look at actually establishing positions, bullish or bearish, typically we're looking at something, with 4 to 10 weeks to expiration. So 4 to 10 weeks to expiration. So 30 to 45 days in terms of calendar days to expiration. Trading days expiration, or something that we might look at, and 45 days falls right within that range. So interestingly enough, options decay the fastest in the last 45 days of their lifespan. So going out and making some bullish shot, selling premium or bull put spread as G7, typed into the Tiger Den, that would be great. But at the same time, the problem with doing something like that is essentially you don't get any time decay if you go too far out. you're basically holding that position. Even though you're getting a little bit more premium, you're not getting any action until the last 45 days. So why not take advantage of the last 45 days and put on new positions, potentially reposition your price level as the market's moving? So again, anywhere from 4 to 10 days to expiration, we're trading right here. Let's call it $28 as the at-the-money strike. What I want to do here is I want to always, if you've listened before, I'm an implied volatility junkie, and always are constantly looking at the probability of occurrence. And the probabilities here are telling me that there's a 32% chance that U.S. Steel, symbol X, trades down to $24 from now until January expiration. Okay? So now until $24, so 45 days away, there's a 32% chance that we get down to 24. So what does that mean on the flip side? Well, there's a 68% chance, and for those mathematicians or engineers out there, that's a one standard deviation. So one standard deviation, or 68% of the time, we would expect, given current volatility numbers, we would stay above $24 between now and expiration. So what is the potential play here? Well, this is kind of one of those funny ones where you don't get, an even strike. So you got the 24 and you got the 22.5. So you don't exactly get $1 or $2, $3 intervals. You kind of get this, you get this funky $1.50, strike interval. Now that said, if we were to sell the vertical spread, the 24, 22.5 spread, that's $1.50 wide. But you bring in 37 cents to do that, right? So you basically have, let's call it $1.10 of risk. Let's say we could work this for 40 cents potentially, but let's just use round numbers. So essentially, you're risking 2 to make 1 is what this looks like. And if you look at that from a probability standpoint, it's about 66%. So it matches up with what these probability numbers are telling us. So if we look at basically a probability or a profit and loss graph on something like this, let's look at it. Well, U.S. Steel currently trading, let's call it 27.77. And our profit and loss graph essentially tells us. It tells us that we are profitable as long as U.S. Steel is trading anywhere above the 20. Let's call it the 23.60 range. And I can hit set slices to break even to get the exact number, and it's 23.63. So, in terms of it being at the top end of the range or feeling like we're a little bit toppy and you want to go bullish, and selling put spreads away from the market are an interesting way to do that, depending on where you get. Now, again, remember the range that we defined in terms of trading are 27.5. And on the downside, 22.5. So clearly, even though we have a downside break even, that's about $3 away from the market. There's still the potential in terms of range, that we could see 22.5 by the end of expiration. So the risk there is still there. But again, even if we peel off, let's call it 10%. Because we're trading at 27.75. If we took off 10% of this stock between now and expiration, you're still in a profitable trade. So it's just a way that we can look at the market. We can say, okay, I'm bullish, I'm bearish, but how do I give myself the best probabilities of being successful? And in this case, you can see if U.S. Steel were to continue above, let's say we break above this 27.5 basically range or resistance that we've set over the last 2 expirations, you would obviously collect that premium for approximately 40 cents or $40 for every one time you executed that spread. Now, if you're wrong and the stock stays where it's at, it doesn't move at all, stays relatively range bound and right around 27.5 into expiration, you're still going to collect the premium. And if U.S. Steel sells off 10% or a little bit more than 10% into expiration, that's still something you would be you would still be in the profitable area of your trade and collecting the full premium of approximately 40 cents. So yeah, no problem. G7 says thanks, and I think. Again, all it is the ability to put on these different positions or to look or to put yourself on the probability side in terms of trading. Obviously you have to be right in a lot of cases in terms of direction, or at least in your volatility call if you're trading volatility. But at the end of the day, there's a difference between just buying outright stock or going a strictly directional play, or being right or wrong but putting on the right trade. It's all about putting on the right trade that allows you to be profitable in the majority of scenarios and situations, and that's a certain situation where I think that works out for us. But again, I have to caution, I would say if I'm looking at this and I'm looking at the chart, I obviously see the top end of a range in a lot of things, not only the overall market, but I'm seeing the top end of a range here in U.S. Steel as well. So, that's a difficult call here. But in terms of taking a position on, if I were bullish here in U.S. Steel, and I think even if the market turns around, I think U.S. Steel could be an interesting equity play as you start seeing some assets or some money move around in different asset types. Now, we'll take a look at a couple of other things here. We talk about trade size on that trade. 10 contracts would only bring in $370. Well, yeah, I think that's a good point. I think, trade size is a function of your account. I think what people don't tend to realize, they say, okay, how big should I trade? Or what's your recommended trade size? Well, it's really a function of the experience. It's a function of the commitment to the trade, and it's a function of your account size. I mean, essentially, if you look at your overall portfolio, I think in a lot of cases, and there's a lot of general rules, but committing more than 5 to 7.5% of capital to an individual trade is, starts to get a little bit dangerous. Obviously, at the end of the day, it depends on delta. I'll talk just a little bit about delta, and let's look at that. When we put on a trade like this, yes, we're taking on $110 worth of risk. So that is clearly something that you have to consider. For every one time you do this, depending on your account size, there's theoretically $113 of risk. Now, the delta of putting on this position is about 10. So what that essentially means is for every $1 that U.S. Steel moves, I would expect to gain or lose on a daily basis $10. So you can see that from a movement perspective, it would be, whatever your account size, if something moves $1, which in this case is just, let's call it a little bit less than maybe 3 or 4%. If that were to be the case, that's a pretty significant move in a stock like U.S. Steel, and that gives you the ability to, I think, manage that position effectively. Now, if I change this, and I'm going to say I'm going to put on 200 contracts here, which is essentially going to use about $23,000 in margin. Well, that's $2,000 for every $1 that U.S. Steel moves. So it's a bullish position. So if U.S. Steel moves up $1, I would anticipate making $2,000 in this particular trade. If it moves down $1, I would lose $2,000. So essentially, I'm going to lose 10% of the capital I committed to the trade. So when you're looking at your position sizes, obviously you have to know the margin requirement, especially in vertical spreads. When you're selling spreads, it's important to know the margin requirement because you want to know, look, if the worst case scenario happens and probabilities go against me and it was a poorly timed trade, can I commit, or am I committed to this spread? Am I committed to the maximum loss here in the spread? If the answer is no, then I think you need to look at either resizing or shortening the width of your actual strikes. Now, in this case, 24, 22.5, 1.5 strikes wide is the smallest increment we could get here. So it's a function of if the trade is there, it's there. If it's not, don't take it. So I think it's a great question, G7. In this case, I think a 1.5 strike interval, it leaves a lot of room. It only costs $110 for every one time you want to put it on to make $40. So again, look at that. I mean, if the bank said that you could put up $110 in capital over 45 days with the potential to make $40 on every $110 capital you committed, obviously there's risk there. But if you're just looking at it from what can I make, I think you're missing a lot of the potential of spread trading. Spread trading, if you look at it, versus the capital you're committing on each individual trade, you start to look at it as a business. I think so many people that start trading stocks, we may be looking to hit home runs every time we trade something. When you start to look at options, you can get further and further away from the money. You can give yourself time to be right. And basically, you can give yourself really the probabilities to be right and time to be wrong. So that when you are wrong, you give yourself a little bit more time to be right. So I think in this particular case, we've set up just one trade here, and I encourage you, if you're in the Tiger Den, you want to give us a call at 877-927-6648. Let's talk. Let's talk about how we may manage some of these trades going into expiration. So really quickly, I mentioned that we talked about something that I found was very, very interesting on the show. It literally happened just a couple of weeks ago as we were talking about this. We saw Frontline Oil, FRO, currently trading $4.29, up 75 cents on the day, and some people say it's only up 75 cents. Well, that's a move to the upside in this security of 21.5%. So clearly a large move in Frontline. We were watching the security, and we saw a significant gap down. Essentially, when we started the show, it was trading right around $3.50, and at the time we were looking at potential opportunity here, was trading right around or a little under $3. So it was trading at $3, and we noticed the three-strike puts were priced at 30 cents. Okay? Now let's look at that. What does that mean? If we were to sell the three-strike put for 30 cents, that means we're obligated to buy the stock at $3. If Frontline, between now and expiration, or the time we were looking at this trade and expiration, traded below or expired below $3, we'd be obligated to buy it at $3. And for that obligation, we received 30 cents to put on that trade. Well, 30 cents to a $3 stock is 10%. So essentially we got a 10% discount to cost basis on this security. Now, what were the risks there? I mean, the risks were that they just announced a quarter of $110, $20 million loss versus quarter before the $40 million gain. But the implied volatility here was close to 200%, okay? And what that means is if a $3 stock has a 200% implied volatility, the upside potential is not only to double, but to essentially go to $9. Well, can you go 200% to the downside? No. So the risk to the downside was $3 basically to zero, so $3 risk versus a 200% implied volatility, so $9 to the upside. So we thought, the idea here was that as a very speculative play, if you were to sell puts, the three-strike put, or even if you wanted to get even more conservative, sell the 3-2 put spread, you basically took in 30 to 25 cents, depending on which one you wanted to do. You took in a 10% of cost basis on the shot that, even if it sells off, I've got a 10% discount to current market price. And interestingly enough, over the past couple of days, you've seen a rally above the $3 level, gapped up to $3.50, and today it's trading at $4.34. So it was an interesting speculative play that we took a look at. We made a very logical trade. Now, clearly, this isn't always going to work out. Frontline did not have to recover. They just announced some reorganization. Essentially, they're going to establish a new company, Frontline 2012, and buy the assets of the old company. But the point is, we made a very logical trade based on information that we had in the marketplace. And I think we got, and for that, we saw an interesting move. Now, we'll do a quick market update. We have a call here. John in Philly has a question on silver options. John, are you there?
Hey, Victor. Yes. Good day to you.
Hey, how you doing, John?
Good, thank you.
Good.
Say, Victor, I'd like your professional help. If I want to speculate that silver is bottoming, and use it with options like short selling a put option spread or something.
Sure.
I'm wondering if you could take a look on your screens and from your point of view, either COMEX silver options or options on the ETF known as SLV. I'm wondering if you could take a look at those and just share with me what particular option series and what combinations might strike you as being, preferred way of, speculating on a silver rally and trying to collect some decaying premium, please.
Yeah, absolutely. So the idea or the sentiment behind the trade is a little bit of a bottom here at the potentially, at the lowest level, probably the 30 range over the last two expirations. But we're coming down into the 31.5. So the assumption is that here we're setting ourselves up for a move above the $32 range, and you want to know a few bullish plays here. And I think I'll utilize SLV. The only reason I'll do that is because of strike selection, one, and because of liquidity. So I'm going to look at SLV, and I think there's a lot of people out there that might not be trading futures options, but I think the strategy that we're going to look at here is applicable to both.
Hey, and thank you for that, Victor. Might I just ask you? I remember speaking with Tom Sosnoff a couple of times in the past. I remember asking him about futures options, and I asked him a question on grain options sometime, and he made a comment about the CBOT grain options being notoriously illiquid. So he made that comment. I'm just wondering, do you have any particular experience level with the COMEX futures options and, generally speaking, whether they're liquid or illiquid?
So in general, I personally, when it comes to some of the commodities, and I'll trade the commodities outright, but when it comes to the options market, and I'll just be honest, I'm more comfortable with the equity or ETF side of the options themselves. So for me personally, it makes a little bit more sense for me to look at it, especially with these ETFs, especially the silver ETF. If you look at basically the volume that we saw essentially over the last year, and I think when we made that huge rally, I think to the 47 level or so 42, we essentially saw the silver ETF in terms of volume eclipse essentially every other ETF that we had at that time. And so we saw an incredible move, an incredible volume display there in that rally in silver. And I think we saw a little bit of pullback, but we're still kind of around anywhere from 11 to 25 million shares per day. And essentially what that means, when you have that much liquidity, the markets are very tight. So I think you don't see, literally I'm looking at the option chain right now, and every, the at-the-money strikes, and I'm looking at January, obviously, are 1 to 2 pennies wide everywhere in SLV. Now, I think when it comes to COMEX silver, you still have liquidity, and I think there's an appetite for that, especially for that product right now. Gold and silver, in terms of liquidity, are increasing, but I still think you get a little bit tighter spreads when you look at SLV, and when you actually, even when you take the multiplier into effect, 1 to 2 pennies wide are essentially the widest you're going to see SLV, at least over the last 3 expiration cycles. Great.
Thanks for that comment, Victor. And I'm in the Tiger Den, so I'm looking with you at your screen on the SLV options chain as you proceed.
Perfect. Thank you, John. So I think, and essentially, we're going to use the same methodology here. Now, what I'll say is from a pattern perspective, and this is just from a pattern perspective, SLV doesn't look as toppy. Clearly, it doesn't look as toppy as the overall market. It doesn't look, it's just a different product. I think commodities is a different asset type, so clearly there's a little bit of an inverse relationship here. But the reason I bring that up is because the VIX here is at 2783.
Okay.
So the VIX at 2783, and the underlying volatility here is in silver is about 47%. So what I'm always looking at is relative volatility in the underlying versus relative volatility in the market. And the reason I'm doing that is to see whether or not it makes sense to basically sell premium, or whether I should be looking to adjust basically the strategy. Now, there are ways to buy premium or buy vertical spreads and still have positive theta. So I think people get the idea that we always need to be selling these spreads because you got to put time on your side. But depending on how you position a long spread, you can be positive theta. Now here, I think it still makes sense in SLV at 47% volatility versus relative volatility in the market at 27% to look again at selling spreads. So we're going to look at it from the same perspective we just looked at basically U.S. Steel. And what I would look at here, I'm just looking at the option chain. 32% again sticks out to me at the 29 level. Now, we've been range bound here, and you can tell me if you agree or not, but over the last couple of expiration cycles, essentially 30, I know I'm picking a round number, but 30 looks like, to me, in the SLV market, the silver market, it's been a relatively strong support level here. We've broken, obviously, a couple times. We even broke down below 28, but the point is 30 has acted as a relatively strong support level. So 29 obviously gives you a little bit more room to breathe. Now, clearly, you could get a little bit more aggressive here at the 30 level. Yep. But I've got to show you here, if I move this from probability of expiring to probability of touching, here's what I've got to ask you. John, when you trade spreads, do you actually place stops on your spreads?
No.
Yeah, and I've got to, so many people ask the question over and over, John. I think you're 100% right. If you've intrinsically built in a stop in your spread. That's why you chose to spread it in the first place. And if you're looking at possibly doing a stop, that means that's a quick signal to me. We had a question in the chat about position sizing. If you're looking to do a stop in a spread, that's essentially a quick trigger or a quick indication you're not comfortable with the position sizing or the number of contracts you put on. Because the long option you bought behind it, especially obviously if you're selling the spread, is something that you bought to protect yourself from a risk perspective. So you're clearly not comfortable with the risk if you're looking at putting a stop on. The other thing I'll quickly point out is there's something I'll call the pucker effect, if you will, but the probability of touching the probability of touching 30 from now until expiration, even though looking at this from a very simple technical perspective, we say, hey, there's strong support at 30. But the probabilities that we go down and actually touch it are about 74%, which means the probability that I'm up and potentially nervous about this trade, depending on how big I put it on, is 74%, because we're right at my strike. Yep. So for those people that say, you know what, 30 is an interesting support number, you've got to look at yourself, your risk tolerance, and your ability to handle risk, especially going into expiration. So you look at this and you say, hey, 30 gives me, basically here, let's pull it up so we can actually see the difference. So if I'm selling this vertical spread, and again, most of my examples, I'm just looking at a one wide, but you can obviously just go, 2 wide, 3 wide, whatever the case is.
No,
it's the short option that's most important to me. So if we're selling this at the 30 level, we're going to get 30 cents versus the 29, one wide, and we're going to get 22 cents. So you can see from a percentage standpoint, it means a lot, but from if we're just looking at 29 versus 22, I don't think it's a huge deal. And the difference is at $30, 74% of the time we're going to come down there, we're going to touch it, and I'm going to get nervous. I might start to manage. I might start to roll a little bit early. Whereas at 29, even though I'm at 22%, I've increased my probability of success. There's only about a 60%, or about, let's call it a 58% chance of actually going down there and risking or touching that. So I think when you're looking at putting on these spreads, it's not just how much do I get versus the risk. It's I want to know myself as a trader, know how I handle situations when we're sitting at my short strike. Am I comfortable with that? Did I size it correctly to be comfortable with that? And if I'm getting more aggressive, does it make sense to move down? In this case, as me, I'm looking at the 29 strike to potentially sell. I think the 29.28 is an interesting spread. It pays you 22 cents, which essentially means you're $1 wide, so you got about a 78% chance of success in that potential spread. So I think 29.28 is interesting to me. I think the relative volatility of this versus the overall market, it makes sense to still be looking at selling premium, even though the VIX is starting to get a little bit low. And I'm just saying relative to the last 3 months, I think that's an interesting play.
Gotcha. Victor, that is really helpful. I liked your discussion there on the probability of touching idea. I hadn't used that with the platform in the past, so that's new to me, and I appreciate that. That's great.
I appreciate the call, John. It was a great question.
Thanks.
Thank you. Take care. So I think, John brings up some great questions, and feel free to give us a call. I mean, sometimes the things that we can talk about here or the things that we can talk about on the air bring us in great direction. And I think, John, the question was, let's just talk about this potential setup in silver. And from that, we start to see the logical breakdown of, you know what, it's not just I'm good at selling spreads or I know probabilities of going to one direction or the other. You know, the first thing we did was let's say, okay, what's the underlying volatility here in this market? It's 47%. What we didn't say was the relative volatility of it to itself. So I'm adding on an indicator here, which is called imp volatility. So I can literally see, you can see over the last 3 expirations, the volatility of the market has been trending down. So relative to itself, it's a little bit low. But we really have to look at what, you know, the entirety here, because essentially you had this huge rally in silver up to the $42 level and this quick breakdown to the $31 level, which clearly is going to increase your implied volatility. And we saw, you know, 70% levels, 80% levels there in implied vol. But still, 46% relative to the rest of the market. Relative to the rest of the market at 27% is still an interesting play. It's still an interesting area in terms of selling spreads. Is it how in the Tiger Dense's excellent discussion? We appreciate that. We appreciate the feedback, and even more, guys, we appreciate the question. So let me read the number one more time. It's 877-927-6648. Want to take a look at a couple of things here. First and foremost, we want to give a market update. It's 1256.50 in the S&P 500. We're up $1.50. So we've rallied $1 since we've been talking, up to 1256.5. The Dow is at 12,131 points, up 66 points on the day. And for those of you following, 1728.80, down $5.70 is the current gold market. And you know, again, I think gold is an interesting it's going to be interesting into the front of the year. I'll say that because here you have an equities market that's approaching the top end of its range. Let's think about this: a top end of its range into December, which is historically you know, a little bit of a bullish expiration. Again, I don't want anyone to trade on that information. I'm just going to say historically it's a bullish expiration. So, and you have a setup that says maybe, obviously, there's not a lot of liquidity here into the end of the year. Maybe there's not a lot of selling for one reason or the other, tax reasons or the next. But, and that may be one of the reasons why you tend to see historically a bias to the upside, maybe a lack of selling going into the end of the year. You know, essentially, institutional money managers are a little bit, maybe they've reached a certain profit target, especially in a year like this year. Maybe they feel comfortable and they're nervous to add a little bit of buying pressure to the market or chase anything, especially at the top end of a range. In addition, for tax considerations or whatever the case may be, maybe a little bit nervous to start selling things and incur tax consequences. But my point is, into January, when you have this artificial pressure, when you have this pressure from this triple witching expiration, what happens with the overall market at the top end of this range? As we potentially, even if we break, let's say, the 1270 area and we approach 1300, which is which is possible, what happens in January? Do we continue that? Do the numbers, do the underlying fundamentals of the economy continue to show us that people are out there buying and that people are expanding? That institutions, I don't want to say institutions rather, but manufacturers are expanding operations. I mean, these are all important numbers. And even though the consumer showed up strong, which showed up for a little bit of this upside blip from the correction, we're still seeing some things in terms of the underlying fundamentals of the economy, in addition to the global or the macro sense of what's happening in the world that's making people a little nervous. So I say that to say this. 1800 clearly has been a strong resistance point in gold. We approached 1800. We did the same thing in gold, and we'll talk about crude here in a moment, because breaking 100 I think is really, really interesting. It presents a couple of trade opportunities. So gold here at 1750 has run into a little bit of resistance. Now, that said, what you're seeing is a very, very interesting candle pattern forming here today. It's what would be considered a little bit of a bullish pattern here, and we might see, and clearly you can't call the pattern before the before the close of the day, but we will be watching essentially how we close and essentially how this market wraps up the gold here, because gold traded to 1750 2 sessions ago. From 1750, we traded down into about the 1725 area, and I'm just ballparking it. It's actually more like 1721. And today we took the market, basically the bears took us down very, very close to 1700, but could not sustain. So we've essentially seen that entire sell-off erased in the last couple of hours of trading, and we have rallied up to 1729. So essentially, as long as we stay above the close of yesterday's session, that could look like a very bullish or kind of a turnaround reversal there in terms of the candle pattern. Now, this isn't a technical analysis show; it's an option show. So what does that mean for us? I think in the initial short term, it could be an interesting bullish play as gold approaches 1800. Now, I think long-term, guys, if you're putting on positions for January, I think it's really interesting or really important we all understand, and I'll pull up GLD for everyone out there so you can see a little bit of the same setup if you want to trade the ETF. Essentially, that level changes to 175, 170 instead of 1800 and 1750. So 175, 170, I think, we're short-term, or there's a potential short-term bullish setup here into the end of expiration in terms of gold, but I also think long-term that 175 level gave us a little bit of a problem before, and I think once we get a little bit closer, it'll be an interesting area to start selling potential call spreads. And if you're looking to say, okay, well, how can I potentially set that up early? Right, because we have some time here. I mean, if we look at the options and how we're priced, we're at 24%. We're a little bit less than the overall marketplace. But if you look at the 175, 176 call spread here in January, you get 25 cents to go one wide. Okay, so again, the levels on gold themselves are 1800 and 175. But in the ETF, GLD ETF, those numbers translate to 175 roughly. I'm just talking about the resistance areas. Those numbers translate to 175, 170. So at 175, if again you're thinking at the 1800 level in the actual commodity or the 175 level, you think there will be a little bit of selling pressure. It could be interesting to start taking those early shots at the 175, 176 so that if we do get a little bit of a correction earlier than expected, you've essentially positioned yourself to take advantage. And also, why this is so important, diversification of trading. If you wait and you say to yourself, you know what, we might approach 175, and if we do that, I'll look at selling the spread. And the next thing you know, the potential underlying market has sold off a couple of percentage points, and you've missed the opportunity to sell at a very interesting resistance level, you might have to then compromise for something else. And I think we've got a couple of issues with sound out there in the Tiger Den. Let me know if the sound is coming through for you okay. Just need a thumbs up out there. Just want to check and make sure we're okay. I think we've got some good content. Want to make sure everyone out there can hear us. Hello, everyone out there. Can you hear me okay? So I think they'll work. Perfect. So we're good now. So again, at the 175, 176 level, 25 cents, meaning you're basically risking 3 to make 1. So you got $75 of risk on the table to make 25 cents. If we rally, you can then obviously layer those trades. As we get closer to 175, potentially you have the ability to start putting on trades or putting on spreads, the same spread at the same strike potentially, at higher and higher levels. So potentially as we rally, you'll get 30 cents, potentially 35 cents, depending on how close to the at-the-money strike we go. So essentially you are changing your break even. And if the market turns around or heads in your direction a little bit early, or you're right but just a little bit too early, you don't miss on that capitalization. So we're just setting, or we're looking at how these things can set up into January, and I think those are some interesting ways to play it. And even if you do see a rally, you're positioned right at resistance, so there would need to be a very strong rally and breakthrough to resistance. Good, good, good. So we've got good sound. So if we have any questions there, it looks like we're enjoying the chat here today, and I appreciate everyone joining in. If you have any questions, give us a call at 877-927-6648. We'd love to take a few more questions out there if we could into the close. We've got about 9 minutes here to go, guys. So 9 minutes. Ooh, give me just a moment. We've got a little bit of... what do we have? A screen share here. Give me just a moment, guys. All right, perfect. Should be okay out there, everyone. So our mic is back on. We are good to go. Sorry about that. As a quick wrap-up, 1256.25 in the SPOOs. That's the S&P 500 up a buck and a quarter, and the Dow trading up $62 here on the day. So we've talked about gold, and I promised to talk about crude into the end of the session. We're going to go ahead and quickly look at the commodity contract that's forward/CL. And we want to look essentially at what we've done here, because we took not too long ago as we were approaching this interesting $100 level, and that was actually a couple of expiration cycles ago. We thought it would be an interesting point to take a bearish position and end up working out. Here we've seen a sustained the breakthrough of the $100 level, that crucial psychological level in crude, for a couple of trading sessions now. And so you're seeing kind of this base here at 100, and it'll be very interesting to see kind of how we shape up. So here's I think the interesting play here, as we'll zoom out here, and hopefully the sound is okay, everyone out there. I think on the upside, in terms of where we are with the dollar, clearly you need to understand what the dollar is doing relative to the world's currencies, and I'll look in this case at the Euro USD trading now at a close to a low of the year, close to the low of the year, 128 at the very, very beginning of the year, but for the rest of the session it was 132.5. Or for essentially most of the year. We're now down to 133. So I think at 133, obviously we're approaching lows here on the dollar, which is why you're seeing this move as you're seeing in crude. Now, essentially, let's bring back everything else that we talked about here in terms of gold and in terms of silver. Clearly, earlier the move was, or the potential, or the idea was that silver had a basing pattern, and you have, and it was a bullish idea that came to us in terms of silver. Well, in terms of that, we're at a low in the dollar. So it made a little bit of sense. And in terms of gold turning around, if we see a rally in the dollar, we might tend to see maybe a little bit of reversal there in gold. We might see a little bit of reversal, obviously, in crude. And crude is where it's most effective. So I think if the assumption here is that the dollar will remain relatively strong, not remain strong, but turn a little bit bullish off of this basing at 132.5, then I think if you correlate that back to crude, there's an interesting bearish play here. And if you're not bearish at this level, clearly you have to understand what that means to a potential dollar play, because that could potentially mean that we might see a break of that 132.5 level in the dollar, and whether or not the inflation, whether or not the underlying fundamentals of the economy replicate what we saw at $1.28. I don't know if we're necessarily where we were then, but in terms of printing money, in terms of what's happening, obviously with our global partners, clearly it's having an effect on where we are in terms of currency strength. So as we wrap up in the day, let's just quickly look again. Let's look at a couple ETFs. So there's a couple of things out there, and in terms of volume, you may trade several different ETFs. I'm just looking at OIL. That's Barclays crude oil ETN trading at 25.72. I think it's interesting because you can definitely see the resistance area it's approaching here. It's most apparent if you looked essentially at where we were trading throughout the beginning part of this year. Basically $26 was a heavy resistance area. We approached it a little bit earlier once we hit $100 in crude, and now we're there again. I think the difficult part, obviously, of something like OIL is the spreads and the underlying options. Even though I think it lends itself well to this resistance area at $26, I think what's difficult here, and what I'll caution you to do, is be very, very aware of your execution prices. If I look at the money here, 110 at 120 is the January 26 call, 10 cents wide, with the 27 call being 10 cents wide as well. So if I look at potentially constructing a vertical spread here, and again, with volatility of 42% in the underlying and overall volatility in the market at 27%, I think that the comfort level there in doing something like that is available. But if I look at this 26 strike, I get 40 cents to potentially sell that. Now, clearly, this is a little bit different than the rest of them. Clearly, if you're not as convinced, or you think obviously that the dollar has room to fall below this 132.5 level, then you might not be as aggressive, I think, in your trading. But interestingly enough, here, if you were a little bit more aggressive with oil approaching and sitting at the $100 level without conviction or moving to the upside, then I think what you're seeing here is pretty interesting, because you essentially have a 60% chance or 60% chance of success. You're bringing in 40 cents and you're risking $60. So I think it's an interesting opportunity there. As we wrap up for the session, we've only got a couple of minutes. I would just ask you to think about that, obviously, because everything we looked at earlier was probabilities. And obviously you would want to move your trade a little bit further if you weren't as comfortable, but clearly there's room to utilize technical analysis at the same time you're utilizing probabilities in terms of trading, and there are ways to get a little bit more aggressive at support or resistance areas. With that, guys, we have had an excellent session. I appreciate everyone who called in, especially John. He had some great questions there. We'll look forward to next week. Next week, we're going to talk just a little bit about constructing some of these positions. We're going to look, instead of just at one leg, one vertical spread, how to utilize multiples. So, again, I appreciate you spending the last hour with us, and we'll see you next time on TFNN, the Options Hour.